Accounts Receivable Financing presented by CPA Financial Exchange Group. So, what is accounts receivable financing? Or another term for that would be factoring. It's basically just selling the accounts receivables of a company to a third party, and then the proceeds of that sale they get to use for their business. So, selling of a company's accounts receivable at a discount typically to a factor or a third party lender who then assumes the risk of those account debtors on the other end of those receivables and receives cash as those debtors begin to settle their accounts. So it's actually a very simple process. Where a lot of people get hung up on that is the actual terminology. But if you were to look at it from a basic purchasing a product and where the cash flow flows from one person to the next, it's pretty basic. This can be done for companies that are startups, so typically less than 2 years. If they're losing money or they're in bankruptcy, because accounts receivable financing is based on the customer's credit or the account debtor's credit, not on the business owner's credit who is actually seeking the funds by selling their receivables. So it's actually who will be paying the lender on settling those accounts. So it's their credit that we're interested and we want to verify. The most common kind or type of companies that are factored are business to business, so not business to consumer. So that's a very important designation to remember. Credit protection with AR financing. So this is very interesting, especially for small and medium-sized businesses who simply do not have the budget to have an in-house credit team or credit monitoring team. And so basically right there, for the average small to medium-sized business, credit insurance can be very expensive and simply unattainable. Fortunately, for some factors, they actually include this in their purchase agreement. So fortunately, for you and for your clientele, the factor that we have available through CPA Financial Exchange Group is one that has in-house credit protection and credit monitoring, and this is going to be a very big asset and selling point to your clients. So your factor that you'll be dealing with is a non-recourse lender, so clients never have to worry about bad debt. So let's say they send out $100,000 worth of invoices, and $25,000 of that is to one particular company or client. Through this factor, let's say this factor looks at those receivables and looks at the credit of those particular vendors that your client is dealing with, and determines that one of those clients has terrible credit or they're going through some really financial hardships. So essentially what they can do is they can turn around and advise your client that says, hey, this particular vendor that you're dealing with is not a very good credit risk moving forward. You may want to limit your exposure to them. And so your client can actually make very wise business decisions based on that. So that's huge. Once your client's receivables are purchased, they no longer have to be associated with those risks. Your factor will use sophisticated credit tools, underwriting procedures to determine how much credit each client and each individual account debtor will receive. So let's say you have 4 different vendors or clients that your client is working with and sending invoices to on a regular basis. Once the credit check and underwriting is done and complete, like we mentioned earlier, then the factor can actually come back and say, hey, this company over here, company A, they're solid. You can lend up to 100% of the invoices coming through them. Client B, however, they're not so great. So we're only going to do 50% of their receivables. And client C, well, they're doing okay, so we'll do 75% of theirs. So as you can see, it really depends, as we identified earlier, on the credit status of the end account debtor, not on your client in particular. So again, very, very important to remember that. And it helps your business client to manage how they run their business. So that's really good. So effectively, the factor becomes an outsourced accounts receivable, credit monitoring company, and collections manager if your client decides that they want the factor to go ahead and do that. No additional price on those scenarios. So, how nice would it be for your client to have a credit analysis team on their side to investigate and research potential account debtors to see whether they should continue to do business with them or enter into a new business agreement with them? So, here's an example of our particular lender that we have through the platform. Several clients had Kodak as an account debtor providing services and are selling goods to Kodak. Not long ago, Kodak's credit rating was unquestionable given the strength of the company. Then they tanked very quickly. Well, prior to this, the Factors credit analysis team had identified trouble with Kodak via their continuous monitoring of their clients' receivables. It just so happens that they're in the same neck of the woods as well, so that helped. Ultimately, the Factor advised their clients to limit and eventually stop their AR exposure to Kodak. And at the time, this particular client said, "Oh, you're crazy, whatever." And then other clients that they advised to do this heeded their word and started to limit their exposure. Well, this monitoring actually saved these clients a tremendous amount of expenses and stress because not long after that advice was given, that Kodak company became unable to pay, and it was really a bad scenario for a lot of people who were caught. So how does AR factoring work? So it's pretty simple, but if you want to make it complicated, it can be. So essentially, a client ships a product to their vendors, and it comes with an invoice, right? Step 2 is the client sends that invoice on over to a factoring company and requests a cash advance on those unpaid invoices. And in this case, it's not really a cash advance, it's a purchase. And step 3, lenders will verify that the invoices are legit, that the services or goods have actually been sent. And then they'll go ahead and underwrite and look at the payment history and the credit of the client's customers who will then be paying those invoices, right? Step 4, lender sends that cash payment to your client who just sold those invoices. And step 5, your client's customer continues to pay the invoice as regular, just as agreed, but instead of paying it directly to the client, now they will pay it to the factor who now owns those invoices. So it really makes a lot of sense. Oftentimes that can go to a third-party lockbox bank account, or it can be a joint bank account with dominion of cash of the lender. They can be pretty flexible on that depending on how your client wants to work that out. Step 6, lender sends the balance to your client minus the discount price, which is typically 3% of the total advance. So if we go back to step 1, $100,000, 3% of that is going to be effectively the fee or service fee that the factor will charge. Industry average is between 3 and 4.5, and this is per batch of ARs purchased. It is not annualized. So if you're thinking of it from an annualized perspective, that's not how they do this. It's not a loan, it is a purchase. So if you were to annualize that, that would really put a lot of sticker shock into your clients. So we need to really make sure that they understand that this is a per invoice batch basis, whether it's net 30, 60, 90, or 120. And if the amount, say this month was $100,000 invoices, next month was 60, the next month after that they didn't use it at all, the fourth month they have it all the way up to 200,000. This advance rate, it would fluctuate according to how much need is there for the client. So if they only need to use 60,000 for that 30-day period, that's all they would use. On the next 30-day period, if they don't need it, it would never be assessed. On the third month, if they needed to use it, it would then be assessed on the balance of those invoices that they were to purchase. So it fluctuates, and it's kind of like a line of credit. You use it and you pay for it. You don't use it, you don't pay for it. It's a really smooth process, and it comes with a lot of benefits, as we mentioned earlier. So I hope that makes sense. How does AR factoring compare to other asset-based lending? So on your left-hand side, your ABLs, You have to have good financial statements, 2 years in business minimum, good financial FICO score, personal guarantees, blanket lien on a lot of your business assets and personal assets, full recourse, of course. So if things tank, then everything's on the line. The customer pays directly. You have to have good customers. The rate, closing time 60 to 90 days. So on factoring, you don't have to have financial statements. No minimum time in business. Your financial statements are not required. Bad FICO or credit score, not required. Personal guarantees, yes for some of them, no in this particular case because our lender does not do recourse factoring. So that's huge. No blanket liens in most cases. Again, here no non-recourse and recourse. Really just depends on which kind of factor you're working with. The funding source or the factor will actually collect the money from the end account debtors. It really is dependent on the customers or your client's customers. The rate is 3% for the first 30 days and 1% per each additional period. So that may seem a little bit confusing. It's very simple. So you have 30 days to collect on those accounts. That's 3%. If they count within 10 days or they balance within 10 days, then they get that a 1% discount. So it's going to be 2%. So again, lots of flexibility. Closing time is 3 to 7 days. So if your client really needs some cash and they've got this asset, otherwise known as accounts receivable, hanging out, and there's a whole bunch of available cash, but it's locked up in that, and they don't want to go, or they don't need to go a traditional lending route with an ABL or something like that, and they need it fast, well, we can go ahead and do some accounts receivables. Accounts receivable aging. So this is extremely important, obviously, and this, as you probably know, is a periodic report showing all outstanding receivables and their balances, and this is broken down by each customer and month that it's due. This is shown over a period of 30, 60, 90, and 120 days, and rarely are invoices greater than 120 days are ever considered for a factor. Obviously, what that means from a factor's perspective, and frankly from your client's perspective, is that if somebody's taking that long to pay, what is the likelihood of them not paying or paying just a little bit of the total? Yeah, that likelihood goes up tremendously, and that's something that the credit team will take into account. So right here, this is going to be a good, solid accounts receivable. As you can see, each of the customers on the left-hand side start out with a balance, right? And then as it ages through the time period, you got 0 to 30 days, 31 to 60, 61 to 90, and so on. The balances get smaller and smaller and smaller, and that's what they should be, right? Your client wants to be receiving payments on their services and products billed on a consistent basis. Obviously, if they don't, then they're going to be losing business and money and increasing their stress. So this is something that we want to see from the aging reports, and that's definitely a huge part of the documentation that we'll be providing to the factor. So this is a good sign that your client's customers are a good risk to advance against, because the likelihood of collecting those outstanding ARs is fairly high. And keep in mind, we always take the net collectible percentage, and that's something that we always want to know from the beginning. So if your client knows that, or if you as the CPA financial professional can determine that prior to submitting the document package to us, then that's better. It really cuts down on time and headache. So here's a poor aging report. As you can see, it fluctuates up and down instead of starting on a high and tapering out. And that's terrible, because as you can see, there's invoices being generated, they're beginning to be paid, and they never reach zero by the time the next AR is generated and sent to those clients. So instead of going down to zero and balancing out, then you see an up and down like this, and that's definitely not a good sign that these clients or these customers are a good risk to advance against. And in this situation, if your client isn't aware of the inconsistencies or likelihood of collections, they probably are, but if they're not, then an in-house credit team would definitely, serve its purpose, be worth its weight in gold. So what type of businesses are good candidates for AR financing? So as you're doing your consultations, your advisor work, looking over financials and things like that for tax purposes, projections, whatever it may be, we're typically looking at small to medium-sized businesses, including new ones, as we identified earlier. And oftentimes they cannot get conventional financing because, they're in bankruptcy, or they're seasonal and they have heavy cash flows one part of the season, and they're starving the next. So on average, we're looking at 500,000. I actually should change that. Our particular factor we work with will go down to 50,000 per month. But this is just a good general scope. So keep that in mind. Any business that needs additional working capital or cash flows injections. And what that means is basically if they're having a rough time getting capital from the first point, which is conventional financing, and now because of that restriction, now they're having troubles. Well, that's pretty easy to see, right? If they don't have capital to put into their marketing to increase new customer flow, which will increase, their revenues moving forward. Well, that's an easy fix. That's something that AR financing can really come in and satisfy that need, and now your downward trend quickly turns into a positive trend because now they have access to that capital. So that's an important point to remember. Businesses are in Chapter 11 or bankruptcy, and they're oftentimes debtors in position or DIP financing. That's a special case, but our lender will look at that very closely. And oftentimes these businesses are behind on taxes. They're struggling to meet payroll because they have to wait and wait for their customers to pay them. A lot of these businesses, as you probably know, don't have a big, deep war chest of cash just laying around so that they can smooth these periods out. And so accounts receivables financing really is a wonderful tool and product to help these businesses out. So what types of markets? We already identified that business to business is the type of industry we want to look at, but now we want to look at the market. So manufacturers, wholesalers, service providers, telecommunication companies, marketing companies, medical industries who are billing third-party insurance or government pays, those work. Newspapers, magazines, trucking industry, there's a huge need there. Food industry, security services and technology, janitorial cleaning services, garment, textile, staffing companies, law firms, construction, etc. So remember, we are wanting to determine who the account debtor is going to be and their credit status. So if you have a client that is a manufacturer or any number of these with accounts receivables of 50,000 per month or more, we can definitely help with that. So why do companies need AR financing? We've already touched on that a little bit throughout this. Obviously, they can get cash quickly, 3 to 7 days of funding. They protect and improve their own credit rating because now they're not taking on additional debt. As you know, if it's a purchase, then it doesn't change their balance sheet. It doesn't change their assets and liabilities. Effectively, what we're going to do is we're changing an account receivable, which is one asset because it's in the asset column, and we're converting it to another asset called cash. So it's not going to be messing up their ratios and things like that from a tax and balance sheet perspective. So it's actually going to be placing them in a better financial position than otherwise. We need clients who are looking for increased working capital. They want to avoid long-term debt. Again, we just talked about the conversion of balance sheet items. And this is good for the business owner because they will now know if their customers have have a high likelihood of default or payment. And this streamlines the billing process as well, because now you have a whole team on the back end who's been doing this for 20 years, um, who are very efficient and proficient. Okay, so here we go. Documents needed for submission. So we're going to want to see driver's licenses. We want to identify who our client's going to be. Invoices that you want to finance, copies of all purchase orders from those clients, copies of all the accounts receivables from those clients, a list of those as you can imagine. 2 years of business tax returns, P&L, balance sheet, interim financials, and year to date, copies of accounts payable and accounts receivables, agings reports. So we want to see everything coming in and going out of the business. We want to get a really good understanding that if we purchase these accounts receivables, two things. Number one, our client who's receiving the funds, that they're going to be actually using that money to go towards business activities that's going to propel them forward. They're not going to be using them to go or settle some debt that they have on their balance sheet. So that's not something that accounts receivable is good for. It's definitely not something that accounts receivable will ever be paid out for, if that's going to be the case. And then number two, we want to see the credit worthiness of the soon-to-be account debtors. So that's essentially what these documents are for. There's going to be a page and a half application that goes along with this, and that wraps up our accounts receivable financing. If you have any questions, reach out to us, and we'll catch you on the next video.